Hey guys, it's Akeem here. Welcome back to another video, and today we're going to be looking into Asos and why I believe the current price of the stock presents a fantastic investment opportunity to outperform the market. Every now and then I come across a stock that I believe is simply too cheap to ignore based on the fundamentals, and these opportunities usually arise due to acute negative short-term sentiment. And with the stock down over 50% for the year, well, I think that this fits the bill. Now, for anybody that has read One Up on Wall Street by Peter Lynch, you'll know that he's a massive advocate for retail investors like you and I to invest in businesses that we use and that we know very well. And for me personally, Asos fits perfectly within that category. Now, for anybody that doesn't know, Asos is an online clothes retailer targeting people in the 16 to 40 age range. And their business model is actually kind of similar to Amazon's e-commerce business in the sense that they operate with relatively thin margins in order to try and capture as much of the market as possible. In other words, their ambitions are for them to be the global go-to retailer for clothes, in much the same way that Amazon is the global go-to retailer for, well, pretty much everything else. Now, because I want to keep this video relatively brief, I'm going to focus more on the valuation side of things as opposed to doing a deep dive into what the business actually does. Ultimately, they sell clothes, right? So it's not that complicated of a business. So let's focus on the valuation today, and hopefully I'll provide you with some value. Let's get into the video. Okay, so Asos is a UK company traded on the London Stock Exchange, and it's currently valued at just over £2 billion. But before we jump into the financials of the business, I thought we'd take a quick look at the stock chart because, well, it's not very pretty. And whenever you see a 54% drop in a single year, it's obviously very important to go and have a look and understand what the reasons for those drops were, whether it is short-term in nature in terms of the issues that are causing the drop, or whether it's a sign for, worse things to come, and is it a falling knife that you're just going to try and catch, right? So in terms of why we've seen the decline, there's a couple of reasons. One of them is that the CEO has announced that he is leaving and he's going to be succeeded by somebody that we do not know yet, so they haven't filled that position yet. So that's part of the reason for the drop, albeit a relatively small amount. The majority of the drop is due to reduced outlook and reduced guidance from management, effectively citing lower profit margins as a result of increased costs, right? And we'll get into the details of those, but those increased costs are through increased freight costs and increased labour costs. Now, if you've been paying attention, we all know how high inflation is at the moment. There's not a single retailer that isn't being impacted by these sort of short-term impacts, right? So if you want to go to, for example, even the bigger players, right? If you go to Nike, just go and read their reports and they will tell you that they are suffering from the same problems. So this isn't so much an ASOS problem as it is more of a sort of a macroeconomic problem. It's not specific to the business and not really a major concern at this point. And things will normalize over time, right? They always do. So that's the first thing I'd have to say on that. Now, I suspect that these issues are going to take a year or maybe even 2 years for them to sort of flatten out a little bit. And in terms of when that might cause to be a problem, is if a company doesn't generate cash flows, right, would be number one. And number two would be that they have a poor balance sheet, because both of those things are going to result in the company needing to raise additional debt or issue shares, right? And both of those things are likely to hurt the shareholder, at least in the near term. Now, we'll come on to Asos's balance sheets and cash flows later on, but ultimately they're not going to be struggling, right? Their balance sheet is good and their cash from operations generation is very good as well. So I have no concerns there. But anyway, let's get into the financials. Just taking a look at the summary of financial results, you'd probably take a look at these and assume that actually the share price over the last year has done very well, right? And the reason for that is because we've seen growth in revenues of 20%. We've then actually seen growth in profit before tax of 25%, right? Which shows a margin expansion, which is obviously very good for the business. Therefore, you look at these results and you think, okay, great, business is performing very well. And therefore, I presume that the stock price is doing the same. Now, of course, we know that stock price isn't doing the same, right? Because we've seen that it's declined over 50% in the year. And the reason for that is it all comes down to effectively their guidance for FY22. So if we look at this profit figure here, for 2021, it was £177 million. And for 2020, it was £142 million. And we go down to the FY22 outlook, and we can see that they're expecting sales growth of between 10 and 15%. Now, straight away, that's not very good because we're used to seeing figures of between 15 and 20% growth. So that's not very good. And then in addition to that, profit before tax expectations are in the range of between 110 and 140 million pounds. So their profit before tax figure is actually going back to what we saw in 2020, despite the fact that our revenues are going to be significantly higher than what they were in 2020, right? So we're seeing margin contraction rather than margin expansion, which is what we've seen over the last year. So clearly that is a big red flag, and we need to understand what is going on with the business, and can we expect those margin figures, those margin percentages, to get back to their normalized level. So in terms of what is actually driving those increased costs, we can see here that notable cost headwinds include incremental inbound freight costs, Brexit duty annualization, outbound delivery costs, and labour cost inflation. Now these are things that, well, apart from Brexit, right, but we don't need to get into the politics of that. The other remaining bits are all sort of factors that are impacting the entire industry, right? It's an entire industry problem, and it's not just a problem for the retail industry as well. Actually, it's a problem pretty much worldwide in every single industry that you look at. And I think that these are relatively short-term in nature. And even if costs do remain high, I think that Asos and other businesses will eventually and slowly be able to trickle those increased prices onto the customer, right? And the reason why I believe that is because effectively, if costs are high for every business within the industry, every business will naturally have to increase their prices, right? In order to survive. And therefore, because it's not a company specific problem whereby, for example, Asos had to increase their prices, but other companies within the industry did not have to increase their prices, then customers and consumers don't really have an option to effectively go somewhere else and not be sort of subject to those price increases. If an issue is affecting the entire industry, then those prices will be passed on to consumers by every company within the industry. And therefore, in theory, none of the individual companies should lose market share. Now, one of the things that Asos are doing, and something that is attracting me to the business, is that they are heavily investing in capital expenditure in order to automate their warehouses. And that is obviously going to be a short-term cost for now. And then in the long term, it should drive operational efficiencies and therefore increase their margins. And so I'm a big advocate of what they're doing there. And they're spending £210 million of capex on these sort of investments on a year-over-year basis. Now that is a lot of money for a business that is valued at £2 billion, right? And in case you're wondering sort of how they're funding that, well, their cash from operations is actually sufficient in order to fund that as well. So they don't have to raise debt in order to make these investments. Once again, I think that that is going to be fantastic for the business. Now, in terms of some of their medium-term financial goals, and this for me is where it gets very interesting, because they say within the next 3 to 4 years, they're expecting or they're planning for £7 billion of annual revenue and at least a 4% EBIT margin, which, by the way, is actually slightly less than their EBIT margins that they've historically been able to achieve. They're expecting capital expenditures, as I was just saying, in the range of between £200 and £250 million per annum. So remember those three metrics there being £7 billion of annual revenue, 4% EBIT margin, and capital expenditure between £200 £250 million, because that will be incorporated into my valuation shortly. Now, for anybody that wants to understand Asos and their mission further, I'd strongly recommend you go and have a look at their Capital Markets Day release. And I thought that this was really helpful in understanding the business. Now, it's 183 pages long, so needless to say, we don't have time to go through all of it today. But what I have done is I've taken some of the key pages for me, which I thought was very useful in understanding where the business is going. And the first one of those is this page here. And this goes to show you that effectively when they acquire a customer, over time that customer spends more and more money with the business, and therefore they become more and more profitable for the business, which is obviously a good thing to see, right? If it was the other way around, whereby they acquire a customer and initially the customer spends a lot of money and then the amount of money that they spend decreases year over year, that would suggest that their service isn't good enough, their products aren't good enough, and it wouldn't be a very good business model. It's quite the contrary for Asos though, and we'll demonstrate that here, right? So for example, if we look here in FY17, in fact, no, let's have a look at customers that were acquired in FY16. So that is the green markers here. In FY16, each of these customers would on average spend £34 per year. You fast forward to FY21, and those same customers now spend on average £104 a year, right? So they've gone from £34, and then 5 years later, they spend £104 per year. So they spend 3 times more sort of 5 years later. So that is obviously a significant amount of growth. And not only that, of course, they are acquiring new customers year over year. So the assumption, right, and I think it's a fair assumption, that over time, these cohorts of customer acquisitions will continue to spend more money as they're acquiring new customers as well. And therefore, that's what is driving the revenue growth in the business. And this one just goes to show that effectively what their medium-term goals are, which is delivering £7 billion of revenue, which is a CAGR of 15 to 20%. I think the most interesting thing here is the 200 to 250 million pounds of capex per year, just because of how significant amount of money that is for a business that is a £2 billion company, right? It is a significant amount of investment in the business, and effectively management are saying, look, we don't care about free cash flows in the short term. We're going to focus on effectively spending money and investing in the business so that in the long term, our profitabilities and our margins in terms of free cash flow margins will actually be much better. And as a long-term investor, that is music to my ears. And then following on from that is this page here, which actually goes to show that, okay, these are our sort of medium-term targets up to maybe around 2025. But they're saying that in the long term, they actually think that they can reach EBIT of more than 8%, which is quite interesting for me. I'm not sure that I'm buying that, not at least with the current business model that they have. But if they could get anywhere near 8% EBIT margins, then this is going to be an extremely profitable business. And there's not a chance that this will be trading at a 15, 16, 17p ratio, which is what it's currently trading at. So if we do see sort of increased EBIT margins as they are thinking that they can, then that will be very interesting indeed. My assumption is that a lot of this is driven by effectively increased operational efficiencies, and that will be driven by effectively the automation of their warehouses. So I'm very interested in that, and they definitely are investing for that, but we'll have to wait and see how that plays out. That is very long term, and I'm not going to incorporate that into my valuations. So then that brings me onto my valuation for the business. Now, I like to use a two-step or sort of a hybrid approach to my valuations. I do it based on a discounted cash flow, and then I also do it based on two different types of earnings multiple models. And I think that that is the best way to be very, very robust in my valuations. So in terms of the growth, I'm planning for a 3 to 5 year revenue growth of 16%. And actually in years 1 and 2, we're expecting 14 and 16% respectively. Now, in terms of where I've got these figures from, these are actually just pulled directly from analyst estimates. Or part of it is management's estimates and part of it is analyst estimates. And then after that, for 6 to 10 year revenue growth, I'm dropping that down somewhat, and we're going to 12% revenue growth. And actually, I should just point out here that management are saying that by 2025, or somewhere between 2024 and 2025, they want £7 billion of revenue. And my model is largely in line with that, right? So £6.9 billion of revenue by 2025. And you can see here that that gives us an EBIT margin, which is this sort of row here, of 3% in years 1 and 2, and then that rising to 4% thereafter, which again is in line with what management are telling us. Now, remember that over the long term, management said that they think that they can hit 8% margins. But just to reiterate, I'm not including that in my valuation because I think that that is incredibly bullish, and there's nothing from the current sort of business model that suggests to me that that's actually possible. So I'm just going to completely ignore that for now. If they manage to achieve that later down the line, then great, that'll be a benefit to me. But it's not something that I'm willing to incorporate into my model. Weighted average cost of capital is 10.3%, and that's a calculation there. You can pause the video and have a look at the inputs if you wish, but it's not all that interesting. Now, in terms of the balance sheet point that I was mentioning earlier, so they've got cash and cash equivalents of £663 million, and we can see that here, 663. And in terms of debt, so I've said total debt is £768 million. Now, the thing to be sort of aware of here is that that figure actually includes lease liabilities, which isn't actually known or defined as debt. So a lot of people wouldn't actually include that in their valuation. For me personally, I do though, and therefore it's included, right? But borrowings, like real debt, is actually £460 million. So they could take all of that cash if they wanted to and pay off all of that debt, and you know, their balance sheet would still be doing perfectly fine. But of course, they're not going to do that because we're in an extremely low interest rate environment, and that wouldn't be a good sort of allocation of capital. But it just goes to show you the strength of their balance sheet. So there's no issues there. So effectively what we get to at the end of our 10-year projection is revenues of £14 billion, up from the £4 billion that we're expecting for the current year. and then effectively profit after tax of £413 million compared with £128 million in the current year as well. So a significant amount of growth. With that being said, I don't think that any of these metrics that I'm using, any of these sort of drivers that I'm using are unreasonable. We're still looking at a 4% EBIT margin. Tax will be around 22%, a sort of effective tax rate of 22%. That gives us a net profit margin of 2.9%, which is actually lower than sort of what we've historically seen, right? So once again, I think that I'm being extremely prudent in all of these figures. And that's why I'm so confident that this is a great business to invest in, you know, alongside all of the other sort of due diligence that we do on the business. We move across to our discounted cash flow. We do this based on EBITDA. Effectively, we're looking at what we believe EBITDA will be and then take into consideration capital expenditures, taxes paid and changes in net working capital to arrive at unlevered free cash flow. Now, effectively take note of the fact that we're looking at capital expenditures of £210 million for next year, and then that increasing slightly all the way through to £250 million as time goes on. And that is in line with what management have said. Management have also come out and said that free cash flows are going to be neutral for next year. And I'm effectively assuming a ever so slight increase as time goes on. So just to point you exactly in the direction of where I've pulled that figure from, we can see here that management have said we expect our capex investment to be £210 million next year, which is the figure that I've put in here. And then he goes on to say that despite this significant amount of investment, we expect free cash flow to be broadly neutral. In other words, nil, right? No free cash flow, which is fine. And that's what we've incorporated into the model for the following year. And then we're expecting capex to increase as time goes on, up to £250 million. So following the inputs through to our valuation, we get a valuation of £26.30, right? So from the discounted cash flow, it's £24.50. And from the earnings multiple model, it's £28. And that £28 is based on a PE ratio of 18 in 10 years' time. We move across to what we think that the business might be worth in 5 years' time, for example. It's a slightly different method of valuation. But ultimately, we determine what we think that EBITDA is going to be in 2026 and then apply a multiple to that. Now, these are effectively just driven from the earlier assumptions, so we won't cover those. The only really sort of variable here is the enterprise value to EBITDA multiple. And the methodology is pretty much exactly the same as determining a multiple for the P ratio. So effectively, we look at what the business has historically traded at and then consider whether effectively there's anything else that we need to account for. So again, if you look at the 10-year average, the average is 46. The lowest it's been over those 10 years is 9.16, and it's currently at 10. So it's pretty much trading right now at the lowest it's ever traded in terms of enterprise value to EBITDA. If we rein that in a little bit to a 3-year period where the sort of profitability is slightly less choppy, the average is still 27, right? So effectively, I'm applying a multiple of 14. Now, I don't think that anybody can argue that a multiple of 14 in 5 years' time, if things play out in the way that we are assuming that they will, isn't prudent, right? I don't think that somebody could make a rational argument for that. I'm saying that they aren't going to be issuing any shares and they aren't going to be buying any back. So shares outstanding remain flat. We get a 2026 price target of £62, and that would be a compounded annual growth rate of 27%, which obviously, or I presume, you know, would be significantly outperforming the market. So that's why I think that there is a significant amount of opportunity in this stock, and I also really like the business. So I hope you find it useful, and until next time, thank you.